The Centaur Flexible Fund has achieved compounded returns of over 270% since inception in 2004. This compared to the fund's benchmark of 186% over the same period. For more, we're joined in studio by the Managing Director, Roger Williams. So the world isn't coming to an end, is it?
No, I think, we've kind of got a new normal where maybe the world is a lot slower and companies have to adapt. So companies have to be a lot more efficient, and really what we're seeing in the world, I think, is almost evolution is happening much quicker in this downturn, where people have to adapt much quicker, be a lot more cost conscious, adapt new technologies, and the fitter companies are actually prospering in this environment.
So the fit will survive?
Yeah, I would think so. But Roger, what do you think of, there's great argument to be made specifically in overseas shares, but some domestic shares as well, that there's exceptionally good dividend yields and you can buy good shares at a nice dividend yield. Do you think the dividends are under threat? Do you think there's going to be some event that's going to cut back the ability of companies to pay dividends? You can buy quality companies overseas that are paying 4-5% dividend yields. You can do the same domestically. Do you think there's a threat out there?
I think, listen, you have to look each on a case-by-case basis. And one thing about high dividend yields, they often are a very good indicator that they're not sustainable. So the banks in the UK, for example, had exceptionally high dividend yields 2006, 2007, and those weren't sustainable. But I think there's a lot of companies in Europe that are sustainable, but I look at Telefonica in Spain. I don't think that is. They've got very high debt. Some of these companies have dividend covers of 1.2 times. That's not sustainable, and they need the capex. So you have to look on a case-by-case basis, but I think you can find 5 or 6% yielders which are sustainable.
If we focus on some of the positives for the consumer, lower oil, which means that ultimately it's going to help our pockets, and secondly, lower inflation. But there's a risk. What about a deflationary environment down the line?
I think there is deflation in some segments, but having, it's quite a difficult environment because food, with corn going up, food inflation is probably going to head north again. Oil hasn't, it came down, but it bounced back. So there's not really as much benefit for the consumers as one would have hoped just 2 months ago. And then there's a lot of industries where there's severe deflation. So if you look at the cell phone business, voice tariffs are coming down, data tariffs are coming down. And
all good for the consumer, not good for the corporates.
Not good for the company.
Not good for the companies, nor for the shareholders.
Yeah. But now, Roger, currently my biggest worry out of all the worries in the world is this thing UK you spoke about now, food inflation.
Yes.
This drought in America, I don't think people have factored in. Now, why I'm worried about that is not because we're going to pay more for food. That's a natural consequence.
Yeah.
But I'm worried about China. If Chinese inflation goes up because of food inflation, the central government and the government there will react to that. They cannot afford high inflation. They've had 2 bouts, I think, in the last 20 years or in the last 15 years. They've had 2 bouts of high inflation, and that they have shown quite clearly that that's one economic ill they cannot tolerate. So what's your opinion on this food inflation, specifically in China? And should it go high, what do you think the Chinese authorities will do?
Listen, I think there may be 2 trains of thought. People may say, listen, it's transient, really, because of the drought in the USA.
Yeah.
And that's what that's actually going to do is going to sap consumer expenditure. It's actually going to make people poorer. So in South Africa, we've actually reduced interest rates last month, despite already rising corn prices, because, people are actually going to, it takes away a portion of their income pie. So I'm not really sure what the response of the Chinese will be. They may just actually let it go and say, listen, it's a transient. Once it's through the system,
it should reverse,
it will reverse. Maybe global warming is actually starting to affect, and that's probably maybe a bigger concern longer term, because I just read an article. If you look at the average temperature over each decade, over the last 6 decades, is actually quite clearly getting hotter. But that's.
If I gave you R1 million, and now just take your funds out of the picture. I gave you R1 million and said, where would you put all my money right now? You can do whatever you want. There's no restriction on mandate. Where would you put my money right now?
I think I'd probably look to, it depends on your, let's say you are balanced. I always try to get the best return with least amount of risk in the short term. So I'd probably put about 10% in property. Even though it's not very cheap, you can still get yields of 7 to 7.5%, which is a lot better than the bank. I'll probably put about 40% in money market at about 5.5%, maybe 15% in inflation-linked bonds, and I'd probably put maybe 35% into stocks immediately and look to feed that in over time. So you'd have let's say the market reversed, you'd have scope to buy, you have some exposure on the upside, and I look to feed it on into the market as opportunities present themselves.
All right, now I'm going to put a different scenario to you. I am aggressive in terms of my risk profile. I've got that R1,000,000. I don't mind whether I lose it. What are you going to do with it?
I'll put it directly into, say, my unit trust in one go, and then you've got complete exposure in day one. I think a unit trust is very easy. You don't have to consider which shares to buy. You're just buying a portfolio in one day.
What would you do with that R1,000,000?
The aggressive one.
The aggressive one.
Because I know you're a balanced aggressive person, so it's okay.
Do you get a balanced aggressive person?
I'll do.
All right, no, if I go with the aggressive, no, I'm an aggressive person, you've got R1,000,000.
Buy resource, South African resource-based shares, because I think they are dirt cheap. As long as you haven't got a 6-month or a 1-year time horizon, on a 3-year time horizon, I think you are going to make a very respectable return on it. But your friends are going to laugh at you or me, or both of us, probably in the shorter term. But the shares are seriously cheap.
See, I just think one has to be cautious on resource shares because people put together models. And I was at Liberty Asset Management in the 1990s, and I studied resource shares, and they're actually impossible to value because it depends on the end price and your costs. So the value really depends on your model, and you're assuming your model's right, which I'm not sure. I think one always has to realize that your models can be wrong. And take, for example, platinum. A lot of people are very positive. I'm not sure on platinum. Platinum could be bad for 5 years, 8 years. I mean,
I'm almost out of time. I've got to ask you one. If you're looking for value right now in the South African universe, an equity, what stock would it be?
I like Sasol at the moment. It just got hammered last week on its trading update. I didn't think it was so bad if you take out the exceptionals. And I think that could go up 20% within the next 6 months. So I'd go for that.